Welcome to the last session of the day. I should remind everyone that this session will be live streamed because we have Governor Yves Mersch from the ECB with us, and according to the ECB rule, should be broadcasted. The last issue that we will explore in today's conference is about how technology and digital revolution will impact the future of central bank. In the last sessions, Governor Theresa was talking about collaborations between central banks, and she was telling a story of a central bank governor in the region giving her a phone call, informing her a few days in advance about a deposit insurance policy that was about to be changed. And that reminds me of an incident last year when I got a contact from my fellow governor in the region, but it came in WhatsApp's message. And he was informing me that his bank had a cyber incident and wanted us to know about the cyber incidents that his bank was experiencing. I think it shows that the world has changed, and this is the new type of risks that we have to deal with. And technology revolutions comes in various forms and has many impacts for central banking. And indeed, it cuts across all functions of central banking. From note printing, we hear the news a lot about less cash society, cashless society, and also the rise of cryptocurrencies. In payment systems, we hear every day is about distributed ledger technology and how we should design a new payment system that is blockchain compatible, DLT compatible. On financial landscape that central banks regulate, banks being disrupted. I think that's a belief in the market. We have new financial service providers that many of them are not under the regulatory umbrella of the central banks. The like of fintech and tech fin firms, big tech firms, will become more relevant in providing financial services. And the roles of big tech firms and their dominant positions, particularly in ability to acquire data and analyze data and incorporate data analytics into financial services, will definitely change the landscape of financial system. And also another key aspect of central banking is monetary policy decisions. And obviously, when we heard about price dynamics, the impact of e-commerce that has taken away price pressure, inflation pressure. The cost of production has also come down as a result of technology development. Labor market is being affected by automation, by artificial intelligence, by machine learning. Cross-border money transfer can be done very quickly using the like of DLT and cryptocurrencies. These are the new ecosystems that central banks will have to experience. Digital revolution definitely will require us to change the way we think, the way we work, the way we analyze information, and the way we communicate. So very delighted to have this very distinguished panel. We're very fortunate today to have speakers who are thought leaders on a number of issues on implications of digital revolutions for central banking futures. We get to hear perspectives from European perspectives, and also Asian perspectives, and also perspectives from central bankers and non-central bankers on this panel. When we think about a cashless society, I'm sure everyone thinks about Sweden. So we're very fortunate to have Governor Stefan Ingves with us on this panel. Governor Yves Mersch has been a pioneer and a champion in driving a pan-European retail electronic payment system, and also setting up a common regulatory framework across Europe to accommodate a pan-European payment system. From Asia, as we all know, China and India are most advanced in terms of digital financial services. But they have adopted, one could say, totally different approaches on fostering innovation and regulatory framework. So we hear from Tan Sri, Andrew Sheng, and also Vijay Mani from the different experiences. So I'll start with Stefan. The floor is yours.
Thank you, and let me say that it's great to be back in Bangkok, and with also many familiar faces that I see both up here on the podium and in the audience. As Veerathai said, and he mentioned many issues, this is a very broad topic, so it's hard to figure out really where to start. So I'll start a long time ago. In my country, the Riksbank has been issuing notes in one form or the other for 350 years. And through all that time, those notes have been the basis of basically the monetary system as we know it. But in recent years, we have experienced a very rapid decrease in the use of cash. The amount of outstanding notes and coins has been reduced by roughly 50% in 10 years. So we are now getting to a point where cash is on the verge of becoming what one could term marginalized. And this is to a very large extent also a generational issue. Young people don't do cash anymore. Old people love cash. That's another way of explaining what is going on. So we can no longer use notes or coins when we pay parking fees, when we pay in many restaurants and cafes, or in some of the stores, and when we pay taxes. And here, yes, my country is kind of an outlier, but on the other hand, these technologies that are pushing these processes are well known everywhere. So I think that many other countries might soon find themselves in similar circumstances. So what really this means is that we have to prepare for a future where almost all payments are electronic in one form or another. And if that's the case, then that raises a natural question. Then what will our role then be in the future, given that we have for 350 years made a living out of producing physical notes that people use? So does this mean that the general public then no longer will have access to central bank money? That's kind of the core question in all of this. And if that's the case, does it matter? Or is it a major thing or a minor thing? Now, in my institution, we have looked into these issues for a couple of years now. And I think that I can say that we have reached a conclusion that, yes, it matters. But that's a value judgment. And it's important to stress that it's a value judgment, because you can also come to the opposite conclusion. So you can't really put a bunch of rocket scientists dealing with these issues, because this is about how we organize things in our society. And that requires, at the end of the day, some kind of a value judgment when you decide what to do. And most central banks have, with a few exceptions, have been given the monopoly power to issue notes and coins. And in many, many countries, this happened roughly about 100 to 150 years ago. In some places sooner, in other places a little bit later. In my country, this happened in the 1904. And I think that all of us who have studied monetary policy and monetary theory sort of have felt that there were good grounds and good underpinnings for coming to that conclusion, that there would be somebody issuing notes, and that you normally, at least in most countries, would not have all sorts of different types of notes floating around. So what history kind of has shown is that a system with private issuance of money in most cases only works frictionless when there is a government guarantee in place that all forms of money can be converted one-to-one into a safe asset, into safe government money in one form or the other. Now, 100 years ago, it was money in the form of paper notes issued by private banks, and then that could be redeemed also into central bank notes. Today, it's electronic money, but the logic has not changed, because money is not about technology. Money is about what we have in our heads. Money is about what kind of conventions we have among ourselves when we transact and when we decide what we define as money in our types of societies. So now, if you look at it from this more historical perspective, then the question of central bank digital currency becomes, I think, a bit less dramatic, because then essentially it leaves us with the reflection, should we move with the times, and should we adapt and adjust to technological change, or should we just sit with our arms crossed and let this thing happen? And I do think that since my institution has been around for 350 years, we would not have been around had we not changed over time. So in that sense, we probably will have to eventually to go with the flow in one way or the other. But with that as a starting point, technological innovation is a driver of human progress, and technological innovation has also helped us to put together and produce a financial sector which probably is more efficient today than, let's say, 50 years ago or 100 years ago. But let me, for a few minutes then, just wear my Basel Committee hat, since I'm also because it's the Basel Committee that sets the global standard for bank regulation, and say a few words about fintech and where we are moving. First, there are absolutely clear benefits from innovation, but these benefits cannot be supported at the expense of safety and soundness of the financial system, because it's pointless to produce new things if they fall apart. So it's still the responsibility of banks and bank supervisors to maintain the same focus on risk management, control standards, and protections when it comes to delivery of new financial services. So in that sense, there are maybe new things to focus on, but the business still remains the same despite the technological change. One thing that seems to be happening now, though, is that innovations have happened many times in the past, but I just get the impression that the current pace of innovation is probably faster than in the past, and that probably increases risks in the system, because fast change can cause disruption, and disruption eventually can cause issues with financial stability, and that's of course an issue of concern. Finally, on the supervisory side, I think it's clear to everybody nowadays, given that you can use Skype at the global level and you can send many emails in 30 seconds across the globe, is that most of these issues are cross-sectoral, and they're also cross-border in one form or the other. And for this reason, I think that all the various organizations and institutions that are dealing with these types of issues at the global level are nowadays talking to each other about setting standards, thinking about how these things should work, because to just sit at home and cook up something completely domestic is not really workable anymore. Now, with those few words wearing my Basel Committee hat, let me get back for a few minutes to the whole issue of a central bank digital currency. Some have raised all sorts of concerns regarding the implications for the financial system of introducing central bank digital currencies. None of those issues are new. They were exactly the same when we discussed cash in the 1800s. But here, it's actually up to the central banks themselves to decide how to design these new currencies, and that's also when you decide what kind of potential impact they might have or might not have when you construct these systems. And as always, when it comes to technical things, the devil is in the details. Now, for instance, it's perfectly technically possible to add frictions to use central bank digital currencies in such a way that they have very kind of cash-like features. But if you turn a digital currency into cash again, well, then you risk losing some of the benefits of a more efficient means of payments. So a careful weighing of the pros and cons is actually what one has to have in mind when we think about how to construct these types of systems. And when it comes to doing this, I think my own view is that smaller countries are in a good position to experiment when it comes to doing these types of things, because it's easier to enforce standardization in a small country. And if something goes wrong, it's not so serious compared to if something goes totally wrong in a very, very large country. And I do think that we will see small-scale pilots over time, and I do think that will also happen in countries eventually where they still use quite a lot of cash presently, because you just cannot turn back time. You just have to think about how to deal with these things and kind of go with the flow. To this end, if I'm correctly informed, I think that we are in the process in my institution to put out another paper on this topic, and that will lay the foundation for a kind of a actual pilot case that we will put together, and it will take a few years to do that, and then eventually we will see where that will take us. But at the end of the day, this is not a decision to be made by the central bank. This is a decision to be made in Parliament in one form or the other, because we are truly talking here about how we want these things to work. And then you get back to the value judgments that I started out talking about. Thank you.
Thank you very much, Stefan. I'm sure there will be a lot of questions later on how the Swedish have managed to move along this journey, and cash is being marginalized. In Thailand, we launched a faster pay system last year. It took us quite a while to gain acceptance, but after crossing a certain threshold, we saw an exponential usage, but we're still only aiming at the less cash society, not to go to cashless society. I'm sure a lot of people may have questions in their mind. Let me now turn to Yves. You can have the floor.
Thank you, Veerathai, first for having me here. Second, let me also, like previous speakers, extend my happy birthday to the Bank of Thailand for its 75 years. And I listened carefully what you said at your introductory statement, that the Bank of Thailand was created in order to create cash. And now the future of the Bank of Thailand should be abolishing cash. So I think it's quite an interesting topic. I will try to approach it in a, let's say, structured way. I think the issue of technological change is affecting monetary policy, and we should reflect upon it, transmission mechanism. Second, it has financial stability issues, as already mentioned by Stefan. It has, as he also said, issues that relates to the payment system, and there I would like to make a clear differentiation between the retail payment system and the public at large, and between wholesale payment systems, which already are largely digitalized within the central banks today. And then there are consequences for regulation. So before going into these different aspects of what we do in central banking in view of technological change, let me say that the technological change inevitably has also a consequence on the broader supply side of services and on the demand side of services. On the what I think we agree is the driver all over is decreasing costs. Decreasing costs is positive because it increases productivity normally, and it's also helping to create new activities. On the supply side, it is a driver for competition, and competition has always been a necessary input for a thriving economy. On the demand side, it will increase the customer's access to a wider range of products and cheaper than they got it before. So from that point of view, I think we can all agree that we welcome all these developments. But now, as always, it is difficult. We agree on a trend, but how fast will the trend get hold of societal change, that is something which is much more difficult, because not every new technology, not everything that was unthinkable before and suddenly it has become possible, is suitable for large-scale applications, and certainly not necessarily for central bank applications which are based on trust. So I think we should distinguish some of the applications from the underlying technology. And what we agree among the central bank community is that we will thoroughly investigate what are possible applications for the digital, distributed ledger technology. And we do it based on in-house testing. Our conclusion right now is that this technology, at this moment in time, is not yet mature for application to central bank market infrastructures. But we will continue to experiment. We will probably have to segment our attempts into smaller slices to see whether there are certain areas where we could, in payment systems, wholesale or retail, where we could apply it. And we will pursue our reflection. But this is our present conclusion within the European Central Bank, not yet mature. Then I would also start with another conclusion, that is what has been pronounced as a digital revolution or money revolution obviously has not happened, because crypto assets that we see floating around are simply not money. They are at best financial assets used for speculative purposes, and they have not been able, as becoming a real means of payment that supplants the central bank liability that is issued through paper cash or through other digital means by central banks. We have seen that the issues concerning these crypto assets on price stability and financial stability for the moment are not overwhelming, because even at the beginning of the year we had a total market share of something like $800 billion early January. We are now down to something like 200, slightly above 200 billion, which is in terms of total financial activity not something that is threatening for financial stability. So this being said, there is still the question that was already addressed by Stefan, that is, to what extent should central bank issue liabilities in digital form, and then to whom should it issue it? Only to banks or to non-banks? The consequences are quite different, and we will have to look at it quite carefully, also in terms of efficiency of implementing monetary policy, because that is finally what we have as a mandate, to have sound and efficient payment systems. And let me not forget that if the Central Bank of Thailand was tasked with issuing a Thai note, it was also to symbolize the emergence or the existence or the continuity of the Thai nation. And let us not forget that those who are most critical of euro banknotes are very often the very populists who want to abolish any form of Europeanism. So it is not always pure agendas that you see behind the proposals to abolish cash, especially in countries where more than 3/4 of the citizens among the 500 million Europeans are time and again asking to keep their currency, to keep the euro. So the euro gets a very strong support from European citizens to continue, whether it be under a cash form or a non-cash form. That was not part of the question. For the moment, a majority cannot yet imagine what a non-cash kind of euro would be. And from our point of view of a central bank, our mandate, as I said, is to promote safe and sound payment systems. Now, we have those payment systems. We are, in a couple of weeks' time, launching throughout all the European nations and even beyond the euro area a system of instant payments that is cheaper, 0.2 cents per transaction, less than 1 baht, which is faster, less than 10 seconds, most less than a fraction of a second compared to Bitcoin, much more environment friendly, and finally more faster, less costly, and more efficient for the European citizens than if we would have any crypto assets that is in existence. So there are other ways for central banks to ensure the mandate of safe and sound payment systems. Let me now say a word about financial stability. I think the new technologies will affect the way we have come about to address our mandate in so far that supervision is throughout the world mostly an entity-based supervision. You have a license as a bank, you have a license as an investment fund, or you have a license to do something, but it is the entity that is supervised. In the new technology, I think we might reflect whether in the future we might not have to switch towards a more content-based supervision, irrelevant of the fact who is the entity behind, because by definition, in a decentralized system, it is much more difficult to determine the liability and therefore also to exercise regulation. We have to have a very balanced regulatory approach because on the one hand we don't want to stifle innovation, but on the other hand we are also responsible not to encourage undue risk-taking, which in the end would turn the consumers away from innovation. But one thing is quite clear. Once you have structures which by definition are more interconnected and which are totally technologically based, inevitably you increase the risk for cyber, by definition. So compared to the sums that are invested right now in institutions to mitigate risk, the sums that are invested in for cyber resilience are still far from being sufficient, and it's being really a risk that we have to take very seriously within central banks to not allow a technology to be spread throughout the financial system if the necessary mitigating factors for mitigating the cyber-related risks are not there at the same time. And therefore, we have created also institutions inside the European Union for addressing this with cybersecurity. Forum has been established on the supervisory side. We force banks to immediately report to a central authority any cyber attack in order to percolate and immediately inform all the other banks about possible new systems, new viruses, and in order to increase the resilience of the system. So these are some of the new attitudes that we need to take in central banks in order to maintain also financial stability. But it is clear that the technology which inherently denies the existence of borders and frontiers would best be also addressed from a regulatory point of view at the global level. And that is what we actively pursue, to have coordination at the regulatory level inside the BIS or other global standard setters at European and international level. Now, one word about policies, central bank policies in the age of digitalization. First of all, as I said, if we would see productivity increases as a consequence of heightened efficiency in providing not only financial services but in the whole economy, that would obviously also affect real equilibrium policy rate, and thereby also the rate that central banks to some extent are targeting. I'm far from being a supporter of equilibrium rates that should be targeted by central banks, and I would rather be quite skeptical, as the new Fed is also in this respect. But it is nevertheless pieces of information that we need to take into account. And to the extent that there would be productivity effects and thereby also effects on the rate of return on investment and hence on equilibrium, real equilibrium policy rates, I think it is something we have to follow as central bankers. It also affects the transmission of monetary policy. As I said, I am not so sure whether the argument that criminals only use cash but would not use digital assets is very convincing. It is rather to the contrary, I would say. But one thing that we need to keep in mind is that cash is also the only direct link between central banks and the citizen. And through cash, citizens also maintain the trust in the central bank and vote for central banks. So the abolition of cash does not come cost-free for central banks, and we should consider seriously if we deprive citizens from having a direct link to their central banks, whether this would not undermine our support in the public at large for the independence of central bank, and whether it would not also diminish the control that citizens will exercise over the central banks, whether it fulfills its price stability mandate. So from that point of view, I would say if we would go digital, it should probably not exclude from the outset that we would have at the beginning a digital representation of cash. But as Stefan has said, there are pros and cons to it, and it is certainly not something we should jump to conclusions, and we have to continue to follow this very closely. Another question where we have to follow is that we have now not only technological change, we have also, because of technology, regulatory change in the payment systems. Inside Europe, we have created a payments directive which allows non-banks access to banks' account information. Payments initiation, payment account services are now allowed by non-banks by using information that the banks so far have considered to be captive and proprietary. Now we have initiated this legislative change, but we see how difficult it is to implement on the technical side. So the question of open banking cannot be dissociated from the change in the technological way of doing banking. And this again cannot be distinguished between not only the distributed ledger technology, but also artificial intelligence, machine learning, everything that increases efficiency and speed, not only in the back end, but also will increase user experience in the front end, because we need customer support, because in the end, it's the customer's choice what means of payment it will take and use. And let us not forget that there are also issues of financial inclusion by doing away with one mean of payment and replacing it too swiftly with another means of payment based on a different technology. Finally, a last word on wholesale. Wholesale, we have already central bank money settlement that is efficient. All our accounts with the banking system and monetary policy counterparts are fully electronic. So from that point of view, what is important is to maintain interoperability between financial market infrastructures that are based on different technologies in the future, because some countries will move to a more modern technology faster because their systems are obsolete, while others would still continue with their systems for different reasons, and they need to remain interoperable. So that is also a big issue that we need to not lose out of sight. Finally, conclusion. Once we have separated the real change from the innovation frenzy, which obviously exists, digitalization represents an unprecedented potential to improve the efficiency and also to improve the reach in financial services. These possible gains must not come at the cost of safety and also not come at the cost of non-negotiable rights, because data protection, privacy rights are also part of the game. We must remain vigilant that we do not fall victim to the hype and that we remain true to our mandate. And at the same time, as central banks in a digitalized age, we must be flexible to adapt our policies, to acknowledge the change in the real world. We must be prepared to test and to adopt new technologies when appropriate, safe and stable. Sometimes we even need to be proactive at the level of central banks. As I have mentioned, we have been proactive in the area of instant payments throughout Europe. We have other areas where we need to push the market a little bit to move faster. And we should not shy away from playing a role in shaping the future in the digital economy as well.
Thank you very much, Yves, for sharing with us a very comprehensive and insightful you have presentation. You have highlighted many issues that we here in the Bank of Thailand and also in Asia are still debating. For instance, issues about moving away from entity-based regulatory framework to activity-based regulatory framework and perhaps platform-based regulations. And this is something that we can come back later on. An issue about data portability, which will be very, very important for the digital age. Let me now turn to Andrew. You have been advising a number of agencies on technological advancements and implications for financial services. You have also been involved with some projects yourself. Perhaps you can share with us your thoughts on this matter.
Thank you very much. First of all, Veerathai, let me thank you for honoring me, particularly personally, to join this very wonderful celebration of the 75th anniversary of the Bank of Thailand. And thank David Mersch for organizing this. It's not going to be easy to follow two real experts who are still in position and every day thinking about these issues. But let me try and, in my very simplistic way, explain how I see what is happening. We live in an age of change, and there are three types of change. The first is constant change, change that is accelerating, and we have to live with it. The speed of that change is just staggering. Every day you see different things happening. Now, the second type of change is simultaneously like entropy, change becoming even more and more complex. Innovation makes things more and more complex. And what do regulators do? They try to make it more and more simple and at the same time make it more complex. Because we need to understand all this, right? So the idea is that there is a constant change, there is complexity change or simplification of change, and finally there is no change. And that's the point that both Stefan and Yves stress. The issue of trust of central banks to maintain the trust in the national currency has not changed. The tools may change, the channels may change, the concepts may change, but there's no change, in the basic what we're trying to do. Now, on this issue, let me very quickly simplify what I think is the fundamental issue of the payment system under the digitization. The first point about digitization, it is everywhere. right? We have already moved to Industry 4.0, or very quickly to the Internet of Things, all right, in which everything is digitalized. And once everything is digitalized and can be transmitted at the speed of light for zero cost, we are in a quantum world. Now, I don't use this term lightly, but the issue is that, digitization means that you can replicate all information, including trust, and degrade it at the same time at zero marginal cost. And so what is the payment system? The payment system, as we see today, is that when I write a check or give an instruction to a bank to pay Yves, to pay Veerathai in baht, it goes through my bank, and eventually my bank goes through the Bank of Thailand's books. So it's a hierarchical payment system, the typology of the architecture, in which on a dollar or a euro basis, it goes internationally higher and higher. Okay? That is a hierarchical ledger system. What is blockchain? It's a distributed, flat, P2P distributed ledger system, in which the instruction to pay somebody with something, I don't care what it is, you go Bitcoin or whatever, is flat across, except that there is so-called securitized blockchain technology in between. That's all it is. So one is hierarchical, in which the top controls, and put it this way, if you use dollars, somebody in the United States knows exactly who you pay to what, and can sanction you if you make payments to illegal or enemies of the state. Okay? In a flat B2B Bitcoin, technically nobody can crack this, or so they claim. So actually there's no perfect system. One is flat, one is bottom up, and the other one is top down. So now once you understand this and the very simple concept of blockchain, that all it is the transformation using an algo, transfer from P to P on a flat basis. All right? And then variants of this to save the electricity and the multiple slowness. You then have wholesale validators in between, so you actually replicate a top-down architecture, but on a private basis. So what are the simple implications? Well, the digitization has changed markets in the last 20 years beyond belief. Central bankers are now having to manage financial markets, 50% of which is quantitative algo trading. And once that happens, who is legally responsible for market manipulation? The program designer, the actual software, the platform company, the intermediary? And when there is a flash crash, who is responsible? Answer, nobody. The legal definition of crime and punishment becomes impossible. Let's punish this algo. You can't do it. And yet, the money goes like a shell game to my pocket. So we have this huge basic problem of anything, if you think about it. What is every fintech startup and big tech platform doing? They basically comprise data, or now you call big data, and algos. And you combine the algo, which is basically artificial intelligence, with big data, you move on three things: speed, scale, and scope, faster than the competitor, and voila, you disintermediate, disrupt everybody, including central banks. So central banks are actually sitting at the heart of all this issue, suddenly facing that the banks that they regulate are being disrupted not so much by the small fintechs, but by tech giants, giant platforms, who have bigger data, faster algo, and multiple market connection. Okay? Every single of these 5, 6 tech giants have 20, 30 times larger customers. A lot of them have a minimum 500 million customers. The largest bank in the world, as far as I know, have only maybe up to 100 million customers. Okay? And when they reach scale, they are beyond borders. To a large extent, who will be the biggest tech platform as it marches across the world? Amazon. Right? And Amazon is trusted. The CFA survey of trust shows that the tech has got 74% trust. Banks have 44% trust, and media has 26%. So the issues that these tech giants are beyond the regulation of central banks. And we don't know how to deal with this because we don't regulate them. And then, of course, the rise of cyber currencies, right? And I think a lot has been said by the BIS and Svein and Yves, so I don't need to talk about this. But essentially, the trouble with cyber currencies is that most of them are scams. And the reason why they are scams is because most people don't understand them. So you take a property company, you change the name to blockchain, fintech, AI, big data, and suddenly it becomes a high-tech company. And the valuation is 40 PE instead of 3 PE. Okay? And anybody can be conned to stay there. So the question really is, we get back to blockchain. And we get back to central banking. Trust. And what is trust? Trust is repeated fulfillment of a contract. Repeated. Trust and action are one. Trust is not about knowledge. Trust is action. Every time you make a payment, you have to verify and you have to trust it. And that's what central banks do. And I love very much Yves' view. If central banks lose the touch of cash with the public, people won't understand what central banks are doing. And so we go back to the basics. The central banks represent the trust of the people in the state. You devalue that trust, you devalue the value of the state, right? Because it's protecting your interest. So how do you verify that trust? Two things. Number one, what's the standard? So the question is, when everybody says blockchain, where is the standard? What is the standard, right? Who says this is true blockchain? And when they say it's blockchain, it's what I call verifiable. Who is verifying it? Central bank verifying it? Deloitte's verifying it? PwC verifying it? Ministry of Defense nobody verifies it. And I just say, I've got blockchain. Right? And if I say that and I cheat you, who is responsible? Is the algo responsible? Because the actual transaction will be done by an algo. Now, this is the other thing. The second point about this is that central bank, in its payments and financial stability, is actually about infrastructure. Okay? But guess who owns the infrastructure for across blockchain that's run? All these millions of servers called the cloud. Who is the biggest owner of the cloud? The tech companies. The tech platforms. So our banking systems are going to be run on these platforms in which they own the infrastructure. I don't know whether they can crack it. I have no idea whether the privacy, and I think Yves is absolutely right, that we do have non-negotiable rights of privacy and safety and protection of our rights, but who does this? And who gives us the right to do this? And none of this is understandable in a sense that we have not yet formulated the rules and regulations to do this. So we are in this stage of change. And in my view, the winner of this innovation game, which is unstoppable, is who maintains the trust of the user. And therefore, in my view, the central banks have a major role in this. And the central banks need not be, I apologize for saying this, the right word is not timid, or cautious. The central banks need to step up and say, this is the inalienable right of the central bank to protect trust. And we need to do certain things in this area. And we need to recommend the rules to get this done. Now, we've already seen this conversation starting, the problems with Facebook, problems with the big guys, right? The privacy rights, the debate between the European approach on privacy, the American approach, the Chinese approach, the Indian approach. We are now seeing a major turmoil that's going on here. And so to a large extent, in my view, yes, I totally understand that change is not totally predictable because we are shifting from one order to the next order. And it's a digital order, quantum order, for which our mental worldview has not prepared us for this, right? But the young generation is already there. In China, the use of the phone to pay money is not by regulation, it's just by practice. It's just adopted. And once, 300-400 million people adopt this, it's the new rule. And so the regulators then would have to catch up and follow on how to write those standards to make sure that the rights of the people don't get disrupted. Because if they get disrupted and they say you didn't take care of it, you have a lot of problems on your hands. So, to me, I agree with, both Stefan and Yves. Smaller central banks have the more degrees of freedom to experiment. And I would encourage, particularly the ASEAN countries to take these kind of experiments in this area, because that's where your competitive advantage will come from. Orlando, thank you very much indeed.
Thank you very much, Andrew, for helping sharpen the questions about how we can maintain trust in the digital age. And then you have highlighted experiences in China where the regulatory framework seems to be catching up with innovations and with developments after the system has been adopted by the people. In India, you have a different approach. The central bank, the regulator, the governments have been very much involved in designing the ecosystem for innovations, and you have seen tremendous changes in electronic payment space in India. Perhaps, Vijay, you can share with us your thoughts on this matter.
Thank you. It's an absolute privilege to be here, so thank you, Governor Veerathai, and thank you, David. And congratulations to the Bank of Thailand on its 75th anniversary. In many ways, I'm an odd one out. I'm a consultant in a room full of central bankers. And usually, in these kind of settings, there's at least one or two consultant jokes. So I thought, why not I say a consultant joke and get it out of the way? So there was a room with 3 people in it, and there was a glass of water in it. And depending upon what each person said about the glass of water, one could guess what kind of person he or she was. So the first person looks at the glass and says, "This glass is half empty." And you immediately knew the person was a pessimist. The second person looks at it and says, "The glass is half full." And you immediately know the person was an optimist. The third guy looks at the glass very carefully, walks around it, analyzes it, pulls out a laptop, makes a presentation, which essentially says, "This glass is too big for the amount of water in it. It needs to be downsized immediately." And you knew he was a consultant. So, jokes apart, let me just, I come here from an India perspective, as Governor Veerathai was saying. Let me just share a few facts about India, which will set the tone for the insights that I will share with you. So, as you know, India is a very populous country, 1.3 billion people. There are about 250 million households. 70% of the population lives in rural areas. The per capita income is just about $1,700, and large parts of rural India survives on less than $2 a day. The banking network is not very widespread. There are just 200,000 ATMs across the country, most of which are in urban areas. There are fewer banking branches than 200,000 ATMs. POS terminals are just 3 million, and again, most of those are in urban India. So while banks have opened a large number of accounts, there are nearly 1 billion bank accounts opened in India. Very few of those accounts are active because there is no access to a bank, no ease of access to a bank branch. And because there are very few POS terminals, while there are a large number of debit cards, 800 million debit cards have been issued, very few actually get used for cashless payments. So that's the context. The whole premise for the last 5 to 10 years has been we need to use cashless payments as a means to get people out of poverty. Because once you have financial inclusion, people become part of the formal economy, and that's a way to uplift them out of poverty. So with that in mind, let me share a few conclusions about the India market, which I hope you might find useful. As Governor Veerathai was saying, the goal in India is not so much let's become a cashless society. It's more about how can we become less dependent on cash. And towards that end, there are various positive implications. One is today in rural India, for instance, the average person has to travel 6 to 8 kilometers to go to the nearest bank branch. And very often they have to give up a day's wages. So there is a serious economic cost to access banking. And the moment you have cashless, that cost comes down significantly. And so there are significant access benefits. There is also a significant benefit in terms of affordability. And those are very, very positive implications which are hard to ignore in a country like India. But technology has been a challenge. As I mentioned, the debit card means of encouraging cashless payments has not worked in India because POS terminals are expensive. And so there has been a search for an alternative technology. And most banks and payment companies have turned to mobile phones, particularly smartphones, to encourage use of technologies such as QR code payments or even tone-based payments which use sound in mobile phones. The problem, however, has been that there are only about 300 million smartphones in the country, so smartphone penetration is not very high. Also, even amongst those 300 million smartphone users, not many use their phones for financial transactions or payments. And so getting people to use this new technology has been a challenge. And so the search is now for other technologies, simpler technologies which rural folk can use. So for instance, how can you use feature phones to make payments? How can you use voice-activated commands where you don't have to open an app and navigate through an app in order to make a payment? Issuing voice commands, and all of us are familiar with Alexa, Google Assistants, and so on and so forth. And a lot of these technologies are being used in India now to try and see how can they be used to improve the lives of rural folk. But going beyond technology, a more fundamental question is, why would a person in a village move away from cash to cashless payments? What difference does it make to his or her life? Yes, you could say, that we will bring you into the formal economy and so on and so forth, but that message is very difficult to convey in theoretical terms. And therefore, the focus in India has been that the value proposition needs to be not just cash, not just cashless, but along with that, you need to provide some product that's of immediate benefit to these people. And what cashless payments do is it enables banks and payment companies to assess the creditworthiness of these people for small ticket loans. And these are not complex algorithms. These provide a good indication of the creditworthiness of these customers, especially for small ticket loans. These are typically people who have had no credit history, so they don't have any credit bureau records. But if a person is paying a utility bill regularly month after month of say, $10, then you can extend a loan of $50 to that person. It's as simple as that. And so only when people see this value proposition do they actually start adopting cashless payments. Up to now, whatever adoption we have seen in the India market of cashless payments, it's been on the back of incentives. There is a lot of VC money and private equity money that has come to India. And the whole idea is that There is tremendous growth potential here for digital financial services. Digital payments is an entry point, but to get people to start adopting digital payments in a big way, you have to give them incentives. And so there is money being spent where for every dollar of a digital payment made, you get some sort of rebate. And a lot of the adoption has taken place because of that. But that's not going to sustain for a very long period of time, especially not in rural India. And so there is a tremendous need to offer compelling products along with cashless payments. There are other such products that can be offered along with cashless payments. For instance, insurance. A lot of people in rural areas have to deal with financial insecurity day in and day out. A crop failure could completely devastate a rural household. A medical emergency could completely devastate a rural household. And cashless payments allow for a mechanism to extend cashless insurance. And so a lot of the focus now is, yes, you offer cashless payments, but along with that, let's offer other means of increasing financial security for these people. Investment is another area. A lot of rural folk don't have access to sources where they can invest their money for a reasonable return. We're not talking about aggressive returns. We're talking about basic returns that a normal person in an urban city in India has access to. And again, cashless payments could create the vehicle for cashless investments. What that means, the implication it has, is that regulators need to come together. The boundaries are getting blurred. This is no longer just the domain of central bankers. There are securities regulators, there are insurance regulators, and very often to launch a product, all three regulators need to come together. And I think to make it easy for businesses, to make it easy for customers to consume these products, there is a need for regulators to come together and involve regulation that will be in tune with the innovation that we are seeing. Very often, I think one concern is, how do you strike a balance? And I think that was one of the questions posed to this panel as well. When is regulation too much regulation? And when is innovation too risky a bet? And I think the answer to that question is really to ask, is there really a customer benefit here? And if there is a customer benefit, then it's worth going down that road. Very often the customer benefit is not very clear. For instance, a lot of startups might come up with a brilliant blockchain idea. Many of those merit consideration, but many of them are not clear in terms of how it would benefit the end consumer. But if the benefit is clear, it merits the regulator to look at it. At the same time, two other metrics I believe are important for regulators to look at. One is, what are the operational metrics around this product? One good approach is to launch it in a sandbox environment, which is quite popular around the world. And then one needs to look at the operational metrics. What's the level of fraud that was seen? Are there other operational risk considerations that are serious? And if they are serious, how do you mitigate those risks? So that's a second important consideration. And the third important consideration to strike a balance is really to look at the business impact. Are these businesses sustainable? As I mentioned earlier, digital payment startups in India are paying a lot of incentives. The question is, what's going to be the long-term viability of these businesses? If these businesses are not viable, then the question is, can they really be custodians of money for their customers? So I think when it comes to balance, those are the 3 points of view that are important. One other point I would make is, while there has been a lot of talk about sandboxes, and a lot of work is happening by getting startups into a sandbox environment, there is one other very useful service that can be offered by regulators, and that's interacting directly with startups. Just plain conversation to figure out, are there different ways of approaching regulation for a new product? And of course, you cannot have conversations with every startup out there. There are just too many. But if it's a new product, and if there is a real challenge in terms of existing regulation, or regulation that spans boundaries, falls between a banking regulator and a securities regulator, then I think just encouraging or having a forum where these startups can come and interact with regulators can go a long way to encourage innovation and also find that balance. I think a few more points I'll make. One of the big issues that has come about in this whole journey around cashless payments, cashless insurance, cashless loans, cashless investments is the question of data privacy. And I'm sure all of you are seized with the issue and are aware of it. Recently, there was a judgment issued by the highest court in India, which came down heavily on the use of biometric authentication. And that has dealt a body blow. And there are also a number of regulations that have come on to do with privacy. I think there are pros and cons when you look at these issues. The key point, I believe, though, is to look at the particular customer that you're dealing with. When you're looking at a customer in a rural area who has no means of access to financial services, data privacy is probably a lesser concern for them than for others, and so they're more than willing to give up their data in return for financial services that would really lift them and bring about economic development. So the way India is headed is there was an omnibus law which allowed any private corporation to use biometric data to provide financial services. That regime has gone. The goal now is to come up with legislation that is more specific, that lays down clear boundaries around the use of biometric data. And I think the idea is to find legislation that will strike the right balance. Look at customers who are willing to give up data in order to get these services. More clearly define what is meant by informed consent. And find that path. And I think this is going to increasingly become a challenge, not just in India, but across the world. How do you define informed consent? How do you strike the right balance between respecting data privacy and also become more and more innovative, provide people with the services they desperately need? One of the other questions that was posed to the panel was on borderless finance. And again, I'll approach this question from an India perspective. The only significant case that I can see is around access to capital. In fact, I was talking with Yves just before we came into this panel discussion. There are a lot of small and medium businesses in India which are starved of capital. In fact, India generally has a capital scarcity problem. And borderless finance, within certain boundaries, within respecting certain safeguards, can solve that problem. For instance, there are a lot of people around the world who would be more than willing to invest in small businesses in India. And borderless finance can really facilitate that and really make these small and medium businesses become the engine of growth for the Indian economy. And I'm sure that's true of a lot of ASEAN countries. Borderless finance can be a means for SME credit and SME investments. The next question that I was thinking about for the purpose of this panel was what should central banks do when it comes to leveraging technology. And I think there are a couple of things that I'd say. One is run as many diverse experiments as you can in the sandbox environment. I think these are excellent environments to try and figure out the implications of different technologies with, of course, the right kind of safeguards. So if there are customers who are part of these sandboxes, then there needs to be enough mitigating mechanisms to compensate them for any financial losses they might incur as part of these experiments. But the more diverse experiments one does, the more one learns about how to use these innovations and what exactly is the benefit. You can actually measure what the benefit is and how significant it is. The other is, I think, clearly data science and machine learning are important tools. And I think there is a lot of data that will be generated by cashless payments. The question is, how do you deploy data science to use that, and how do you strike the balance with when it comes to data privacy? What are the challenges that central banks face when it comes to realizing all this potential? I think one is clearly talent acquisition, and a number of panels before this panel did talk about it. Technology talent is hard to acquire for all businesses and all organizations, and certainly it's a challenge for central bankers as well. I think one important challenge is also to look at old standards, standards that might have become out of date, but are so well entrenched in the system that's really difficult to update those standards. And I'll give you one example. In the India market, we have a standard for micro ATMs. Micro ATMs are basically small handheld devices which are used to authenticate customers in rural areas before you dispense cash to them from their accounts. And there is a technology standard for those micro ATM devices, which includes giving the bank customer a printed receipt. Now, there was a time and there was a reason for that, because the printed receipt was something that the customer could use later on in case he or she wanted to dispute the transaction. But today, mobile phones are ubiquitous. The printed receipt can be replaced with an SMS message with the same information. And so there is a lot of debate and discussion now to see, can that old standard be updated? To my mind, this is a big challenge for central banks, to figure out which standards need to be updated, which standards do you leave as is. Finally, I would say that when it comes to these fintech companies, it's really important to understand, what is the business model for incumbent banks to engage with them, and what's the technology model? In India especially, we started off by looking at fintechs as competitors to banks. But increasingly now, the perspective is fintechs and banks are collaborators on this journey and not really competitors. But really, the problem that remains to be solved is what are the different models that can be used for engaging with fintechs commercially? Should it be revenue share? Should it be flat fee? Should it be license fee? There are multiple models. And what are the technology models to engage with them? Should we have an open API system? Should it be tighter integration of a different sort? And those are the kinds of problems that banks are trying to solve. And those are the kind of problems that the central banker and other regulators are also trying to understand. So we can come up with a more standardized model. So those are the thoughts from India.
Well, thank you very much, Vijay, for highlighting a number of issues related to regulatory framework. Before I open the floor to audience for Q&A, maybe I'll come back to the panelists on one question on the modern regulatory framework that central banks should think about. Yves mentions about regulating by activity as opposed to moving away from regulating by entity. And Andrew also touched on issues about big tech companies coming into financial services, competing with banks, and issues about level playing fields, flows of data. Maybe ask Stefan, as you have been the chair of the Basel Committee, to which extent this issue has been
If it looks like a bank and walks like a bank and walks like a bank, it's a bank. And that's just the way it's got to be, because otherwise you're going to end up with all sorts of difficulties when it comes to that. But then there are different types of banks, and I think this particularly holds when we're thinking about how banks connect to central bank payment systems, because you can imagine or come up with a small bank which never really participates, let's say, in monetary policy transactions, and which is basically an expert in making payments. So that's one type of institution. And then you have a very large number of medium-sized and large banks that participate in various types of monetary policy transactions, and that's a different sort of set of banks. So under the umbrella of what you call a bank, I think eventually over time you can sort of fit many types of different institutions.
I think India has also adopted that approach with your payment bank license.
That's right, yeah. So the idea of the payments bank was how do you reduce the systemic risk of getting new entrants into the banking system? And one of the big sources of systemic risk is when a bank starts making bad loans. And so the experiment that has been tried out in India is to get a differentiated banking license where the bank is allowed to collect deposits and provide payment services, but is not allowed to make any loans. They're allowed to distribute loans, so the underwriting responsibilities of someone else. And over a period of time, as the payment bank gains experience, they might be given the opportunity to apply for a universal banking license.
Mm-hmm. Thank you. Any questions from the floor? I see 3 hands. Maybe ask Dr. Suthat, Diana, Kuntarisa, and the gentleman here. So first I'll ask 4 questions first, and then I'll ask the panelists to respond, and we will come up to the second round. So Dr. Suthat, please.
It was amazing how far we moved, and the time is now at the end. The panel discussed using the digital technology to replace basically money. And one of the important functions of money is provide you the unit of account, where we price the commodity, price the product and services. When we do the pricing in this country, we have our own value. But when you transfer money across, then you need to assess it against the exchange rate. And at the end of the day, the central bank of each country define that. What is the exchange rate? What is the value of our currency vis-a-vis another country? So how will this payment system affect this valuation system, particularly when you can't control the flow of money that are going in and out, like what we have done in the past? So how would that affect the role of the central bank when the international payment system is all evaporated into one system? Thank you.
Thank you. The second questions? Oh, you already have the microphone. Maybe you can start.
Hi, thank you. Anthony Lewis here. This is a question for Stefan and Yves. I thought the conversation around central bank digital currency for citizens was fascinating. And when it comes to defining the token itself, so physical cash has 0 interest and is identityless or anonymous. And I was wondering, my question is, how far are we with the thinking of what a digital version of physical cash would look like in terms of anonymity and in terms of interest? And has that progressed over the past year or so?
Thank you. And the third question? Microphone. Hey,คุณผู้หญิง. Thank you.
Thank you, Governor. Thank you to the panel for your remarks. These have been very interesting. I have a question. If you could elaborate a bit more on the difference between the token-based and the account-based retail digital currency, and what your views are on these 2 types. And more specifically, I'm also interested in the context of Europe, perhaps hearing from you, Yves, on a bank-centric system, how that would impact the financial stability if people have accounts with the central banks. Will there be competition with commercial banks? And also how it would affect the central banks operationally. We had this discussion with another central bank governor who is not here today earlier in the year, and he said with regards to account-based digital currencies that I'm not going to turn my central bank into a call center, because there is a lot of operational changes that you need to make if people end up opening accounts with the central bank. So what is your view on these issues? Thank you very much.
Thank you. And then Governor Tharisa.
These brief questions for the Vijay. You were talking about giving different licenses to banks, and you were implying that perhaps it's less risky to grant a license for just deposit taking and payment functions, and then save the function of the loan creation later on to see perhaps some track record. And I was wondering whether that is what's the implication of that? I would have thought that if you are allowed to take deposits, usually we would be very much concerned about the safety and soundness of the bank in its ability to return the depositors' money. Obviously, the implication here is that if they don't make bad loans, that is fine. And I don't know whether in India's case, they are allowed to make use of the deposits they have by extending the loan through some underwriters or if you would elaborate on that, it would be very much appreciated.
Thank you. Thank you for the first set of questions. Anyone would like to take the first questions on the valuation? Yeah, Stefan.
I can give it a try. I think the first question, and maybe I'm not interpreting it correctly, but to me it sounded like you were talking about a floating exchange rate. And that's the way it is already. And the vast majority of all foreign exchange transactions are already digital and have been so for years. So it's how you move sort of cash across borders is fairly limited. On central bank digital currencies and how to construct them, that's exactly why when I made my remarks earlier, said that it takes value judgments to come up with these things. So that it's not that there exists, there's no rule book for this. And people have all sorts of views and thoughts and ideas, and they always think that somebody else has decided the way it's supposed to be. But that's not where we are. It's too early for that. On identification, one must be mindful of the fact that already today, when it comes to, let's say, bank deposits, all banks in most parts of the world have to comply with anti-money laundering and combating the financing of terrorism regulations. And those rules and regulations are fairly limited in terms of the amount of money that you can actually deposit anonymously. And all this, if you do these things in these new ways, all those rules and regulations will apply as well, unless in some corner of the world you deliberately decide that those rules are not supposed to apply. But if you do that, then you probably will end up with a serious problem with the FATF pretty soon. So I would say don't go there. On the issue of token or account-based or not account-based, you can do both if you want to, and you can choose one or the other. You can do something token-based, more like kind of physical cash, but at the end of the day, you just have to decide which way to go. And on the issue of competition or no competition, there's a wonderful paper written by a group of people at Bank of Canada where they compare the use of cash when cash is also, when notes are also issued by privately owned banks in the late 1800s, where they compared the US, Sweden, and Canada, and there's nothing new under the sun when it comes to that. It's exactly the same debate that people went through 100 and 150 years ago in terms of what should privately owned banks be allowed to do and what should the central bank be allowed to do. And that conversation 150 years ago in most cases ended up being, and with the end result, one entity is issuing cash, and that tends to be the central bank. But all those conversations will come back. Whether one should pay interest or not, to Yves' point, it sort of depends on how you want to run monetary policy. You can choose not to, or you can choose to do it. In both cases, it's fully possible to conduct monetary policy, but the way you do it will differ a bit. So those are really, nothing has been decided. Those are sort of future decisions to be made by somebody in some corner of the world eventually.
Thank you, Stefan. Yves, there was a question to you on cryptocurrencies and pan-Euro.
Yes.
No, sorry, central bank digital currency and pan-European thinking.
Well, I think that to take a simple example, a payment system is a convention. If I agree with you that I pay you with a token that we agree upon, and I say it's my Thai, it's a gift from Veerathai, so I will say now this Thai is worth 100,000, and you accept it. Then we have a unit of account. We have a means of payments because you accept it for payments, and you even might have a means of investment because it's very hefty price. But the problem is that the only one who know it, these payment systems, is you and me. And that is the difference with a legal tender, where it is the legislator who has said the unit of account is the national currency, and we have a national institution that is charged with issuing the currency and is also in charge of maintaining the stability of the currency in order to maintain the trust in that means of exchange, unit of account, and value. So that is the whole difference. So tokens are allowed and possible. You only have to have enough silly people to believe in it. That's the difficult part of, but so many people always try to get the advantage that the central bank has gotten by the legislator and by the democratic institutions to issue currency. So you have now tokens which say we are backed by official currency, but asset-backed or central bank liability-backed private tokens, why would you use them if you have the official currency at hand? The only issue that this would create in addition for central banks is that they will hoard pockets of liquidity that will not be used where central banks would like to use the liquidity necessarily, and will make monetary policy control more difficult. So I really do not see yet what would be the outstanding advantages, neither to the customer nor to the overall benefit of the economy, if we would move to something which is different from the system that we know now. Of course, if we would decide to change the underlying technology, and instead of issuing a banknote either in paper or in plastic or in another technology that is available, that would not necessarily change the way we issue money and we control money and the flow of liquidity, because that is our mandate.
Thank you. Vijay, there's questions for you.
Yeah.
Payment bank.
So the background to the payment bank construct was that banks had become, by virtue of their size, the large balance sheets, they became extremely unwilling to go and service the poor customer. And so the idea was, how do you construct a bank where they start giving fee income more attention than interest income? And so the idea was, let's take loans out of the equation. But unless you take deposits, you can't provide payment services. So the way the risk was controlled was to say that while you can take deposits from customers, you can only invest them in safe government securities. So at least 75% of the deposits raised by these banks have to be invested in government securities. And the rest also are typically invested within the banking system itself. So that's the way the systemic risk is being controlled. They also have to file regular reports with the regulator to report their net worth, so that they're not burning too much cash, to deliver these services to customers. They have to maintain a minimum net worth at all points in time.
Thank you. I see two more hands for the second round of questions. Any more hands? Okay. Hans, please.
Thank you. Very fascinating discussion. I was very intrigued by Andrew's emphasis on trust. And I wonder if you could elaborate on what you think about the payment systems or practices in China, where you worked a lot, where there are companies that essentially, for what I understand, run payment systems which are private, and a lot of people seem to trust them. Are we in a situation where a new generation of people, customers, individuals, don't need or will trust technology more than they will trust the old central bank, 350-year-old central banks? Is that what is happening?
Well, what is innovation? Innovation is gray rules, put it this way. You know, you breach the rule, but it's gray. It's not black and white, right? I mean, you create something that the rules doesn't talk about, and it's innovation. And the regulators, either they enforce it or they shut half an eye. Now, everybody understands that P2P was the way to go, and that's the way the technology is, and that's why the Chinese regulators said we shouldn't stop P2P. And unfortunately, if you don't have enforcement, there's a lot of cheating out there, and now they've discovered, and that's why they're banning P2P. I mean, they're unwinding it, right? Because the trust is not there. So it's very, so regulators, if you actually enforce the law to the degree in which you block innovation, you actually impose a cost on society. If you don't block it, you have a personal risk because people will say you didn't regulate it when you should have regulated it, right? So the tendency is for regulators to be cautious and therefore ban this. The difficulty with the digital economy is that all information can be replicated at zero cost. And so that the trust element on information imposes itself a cost to verify that that information is trustworthy. Okay? So there is no currency that cannot be faked, that cannot be corrupted. That anybody who tells you that technology cannot be hacked is lying through their teeth. All systems can be hacked. It's only a matter of time and the power of your computers and the ingenuity of somebody. So the trouble is that, there are no perfect systems. And information is fundamentally unequal. And so I think, what we have now I've been silent on this issue because the trouble with information systems and therefore financial systems are essentially information systems, that they are unequal. And therefore to maintain that equality and access to information, access to finance, access to knowledge is, changes the rules of the game a lot. So, just give me a simple illustration. Who invented digital payments? Not the advanced central banks. Central Bank of Kenya, which basically allowed M-Pesa. They didn't understand this. They said, why don't you allow the telephone company to do this? And they invented it. So, the point is that, and people in Kenya use this all the time. Of course, there's some cheating out there. And there's some hacking and there's some stealing. But by and large, it actually serves the public good. And so we need to judge this on how its usage. So I think the central bank needs to get back to the basis. Is your work in maintaining trust in the currency, given the balance of the issues, maintaining the public good? Or are you protecting vested interests? That's the other issue.
Thank you. Stefan, you would like to add something?
Kind of a reflection on this is that when we're talking about transfers of money from one individual to another, we use the word money, and then we automatically make the assumption that somebody has decided already what money is. And as Yves said earlier, that's usually done by a parliament someplace, because that's the safest way of defining what it is, and it takes the rule of law to do that. And the rule of law is usually produced by politicians and parliaments because they have the monopoly power to enforce those laws. And this is important when we talk about payment systems, because if we're thinking about an imaginary transaction within the private sector only, then essentially what that means is that if you transfer something from my bank to your bank without the thing passing the payment system run by the central bank, the only thing that happens is that your bank ends up with a claim on my bank. And banks and bankers don't trust each other. So it only works when the whole thing passes the payment system run by the central bank, so that you actually transfer central bank money from one bank account to another. And that's kind of the definition of a payment system run by the central bank. And that's why all privately owned banks always prefer to transfer whatever you call money through the payment system run by the central bank, because that's the true definition of money. And in addition to that, which has a very special legal meaning, central bank payment systems also generate finality. It's a transaction that you cannot reverse. The money just went through the system. And this is also why, and people never think about that when they transact, is that when you send money from one cell phone to another, that sum of money is always going to pass through the payment system operated by the central bank in one form or the other. As an individual, you need not understand at all how this happens, but this is how it happens, because without that feature, it would not be possible to move real money from one cell phone to another.
If I may add,
even Kenya, like that.
We did a number of market research surveys in India, to get an understanding of how well some of these cashless payment services would be adopted. And what was very clear, and it seems obvious now, is that people trust what they understand. And so a lot of people were willing to trust an old institution simply because they understood it better. They were familiar with it. And we found that people who used the technology tended to trust it over a period of time because they figured how it actually worked. So I think as people adopt technology, and technology adoption could be different for different people. For people in rural India, it's adopting a simple payment service. For people in urban India, it could be adoption of a robo-advisory service. But as people start using these services and they understand it better, that's when trust will grow. Right now, most people prefer to trust old institutions because there is an experience, there is a level of understanding.
Okay, I think we have 8 more minutes for the second round of questions. There's a question from the back, gentlemen.
And this is to Dr. Andrew Sheng, please. I'm Thamrak from Thailand, Bank of Thailand. I'm just wondering, I agree with you about the tech giants having more speed, more scope, and more scale. And that customers actually are happy using this tech platform for their purchase. But if the central bank, let's say if the Fed doesn't allow Amazon, just for example, to actually take deposits, then the larger banks are not so much worried about Amazon at all, because it seems that although they can process payments, they're not taking deposits and becoming direct competitor as such. But if the Fed actually thinks along the way of India, for example, where they issue another license for the likes of Amazon to become a payment bank, for example, then probably there is some transition period that Amazon might have to learn about banking to do it properly. But then the situation would be different from India as well, because currently Indian banks can put money into government securities, which probably give them 6 to 8%, for example, but securities in the US probably lower. So how do you reconcile between these two models where customers could benefit from using the platforms, but then you are having platforms that are running financial institutions which they might not have the expertise to do it as such, but they can compete on scale, scope, and speed.
Okay.
Thank you.
Any more questions from the floor?
No, I wanted to reflect a little bit on what Hans said. So it's not a question. So
okay,
should I go
1
now?
minute.
Okay, 1 minute. Thank you. So Hans, on your question, you mentioned that the younger generation perhaps trusting the fintechs or the platforms, especially in China, I think you said, more than the central banks, and it seemed like this lot or that lot. But if you think about what that you're actually transacting in, when you load up the WeChat app, for example, and you're sending renminbi, right? So you're still sending a central bank. It falls back on the credibility of the central bank. You're trusting the apps to debit your account and credit someone else's account, but the thing is still the fiat currency of the nation, which you're trusting the central bank to look after and maintain price stability. So I don't think it's them or them. I think they're riding on the credibility of the central bankers.
Okay. I also have the last questions for Andrew. You mentioned about collaborations between central banks, perhaps in ASEAN, to be able to navigate the challenges of the digital age better. And obviously, we don't have scales like in India or China. Perhaps if you can share some thoughts on what would be the priority areas that central banks in ASEAN should collaborate on this matter.
I think the ASEAN central banks have one major advantage. We're very, compared to the giants of Europe and America and China and India, relatively small and, very engaged with the people, as it were, because, ASEAN has been a very much more equal society, community-based. So to me, two things need to happen. One, we need to start talking to the tech platforms on how they're going to use that big data, not for their commercial advantage, but actually to serve the people. I think that's very critical. Our big disadvantage is that our banks, I'm sorry, this is just in a very general terms, are smaller in scale. Our technology is not so advanced. And even if we use their servers, the cloud, effectively we are actually a server to a big cloud, which is owned by the big tech giants. Let's be blunt about this. So actually it's not about the actual hardware, then that hardware can be tested. The more interesting issue is how do we actually use the digital economy to serve our people better? Now that comes back to your question. You see, the point that I've come to realize that payments value are information systems. And knowledge, if you get access to the knowledge, you can actually, become part of the global commercial world. But if you don't have access, you're in deep trouble. The income and wealth, gaps have become bigger and bigger. And that's why the rural areas have a serious problem, because they have, they don't have access to a mobile phone. They don't even have electricity, a lot of them. Now that's where, if the digital technology has changed the game, I just share this with you because, I'm a total amateur in this, but coming to a very new field, I suddenly realized this. What is the greatest free energy in the world? Sunshine, which is free to everybody. And the minute you have extract solar power, which is now the same as cheap as coal, even in the rural areas, you can actually provide that energy to the grid, which is the public good, which is the network. And the minute you access that energy to the network from the rural areas, you will have income. If I may put it very bluntly, right? So if you're sitting in the middle of a Sahara and you have an actual grid, you actually get free energy and you convert it to energy, and then you can use that energy cost to actually, charge your mobile phone and then use it to do Alibaba or payments systems transactions. So to a large extent, but the algos to get these things done is itself an infrastructure and public good, for which nobody helps the poor person. And with all due respect to Vijay and consultants, they're always trying to monetize this. And monetization is private, it is not public good issue. And that's where, in my view, the central banks have a role. to a large extent, how do central banks actually work, to make the payment system and the energy grid? I'm not saying that we get into installing power plants, etc. Just to think about this issue and actually help equalize society and engage back into the trust of the small man, a small person, woman, or whatever, right? And at this point of time, in advanced societies, this is now disengaged. Less and less, because, people are all into their own thing. But in less developed, put it this way, societies, that engagement the trust element is clearly there. And we used to do this through cash, but this is now changing, the game has changed.
Thank you, Andrew. Well, thank you very much, all the panelists. This panel has been very thought-stimulating and very, very exciting indeed. You all have highlighted a lot of thinking, a lot of dimensions that we will have to think about the future of central banks in the digital age. And I think one keyword that has come up many times is how we can maintain trust, central banks' trust in the digital age. And I think we can have a week-long conference on this matter. It covers different dimensions from cash, the new forms of cash, digital cash, to payment systems, central bank payment system, and also the new regulatory framework that we should think about when we have to regulate new players coming into space. So ladies and gentlemen, please join me in thank you the wonderful panelists in this session. And lastly, on behalf of my colleagues at the Bank of Thailand, I would like to thank governors, former governors, and speakers, and all participants for your presence and also for your wisdoms here today. I would also like to thank David Mersch and your team at Omfif for helping organize this wonderful seminar. I believe that all of us have learned a lot and have also asked a lot of questions that will need to be further researched and explored in years to come. And again, when we talk about shaping the future of central banks, we should add the last word, shaping the future of central banks' trust, or trust in central banks, and that will continue to be key questions for all of us. So thanks again for your participation, and I wish you all a pleasant stay in Bangkok. Thank you very much.